We've spent a lot of time talking about compound growth, how wealth, skills, and advantages can accumulate over time. But today I want to introduce an idea that serves as an antidote to a lot of motivational advice. Understanding compounding is not enough. Sometimes, even when you know exactly what the right move is, reality still prevents you from capturing the gains. Let me start with a personal story. Back in 2013, I owned 16 Bitcoin. I bought them at around $700 each. If I had simply held them until 2025, when Bitcoin crossed $100,000, those coins would have been worth over $1.6 million. But as you probably guessed, I didn't hold. After less than a month, Bitcoin dipped slightly. It wasn't even a major crash. I got nervous and sold. Then I decided to pursue something more exciting. I used the money to trade stock options. That ended exactly how you think it did. I lost everything. I've told this story to many people, and nobody laughs. Because everyone understands the real lesson. Almost nobody could have held. At the end of 2015, Bitcoin traded around $300. Anyone who bought then and held until today would be extraordinarily wealthy. But what would they have experienced along the way? By late 2017, Bitcoin had reached nearly $20,000. Could you really watch your investment increase 60-fold without taking profits? Then, in 2018, it crashed to roughly $3,000. If you hadn't sold before, wouldn't you regret it now? Then came 2021, when Bitcoin climbed to nearly $70,000. Suddenly, not selling looked brilliant again. Then it fell. Then it rose. Then it fell again. Over and over. There are probably only two kinds of people capable of holding an asset like that for more than a decade. The first is someone who literally can't trade. Someone in prison, for example. The second is someone so wealthy that the money doesn't materially affect their life. Today's mental model explains why that second group often has a huge advantage in investing and in many other areas involving uncertainty. The concept is called non-ergodicity. To understand it, let's start with a simple game. Imagine a coin-flipping game that lasts 100 rounds. Each round, there's a 50% chance of heads and a 50% chance of tails. If heads appears, your total wealth increases by 50%. If tails appears, your total wealth decreases by 40%. Should you play? At first glance, the answer seems obvious. The expected return is 50% times 50% gain plus 50% times 40% loss. That's a positive expected value of 5% per round. A positive expected value sounds fantastic. Who would refuse? Now imagine you enter the game with $1 million. Suppose your luck is perfectly average. Half the time you get heads. Half the time you get tails. After one winning round, your wealth becomes $1.5 million. After one losing round, it becomes $900,000. Why? Because 1.5 multiplied by 0.6 equals 0.9. Every win-loss pair reduces your wealth by 10%. Repeat this process over and over, and something shocking happens. Even though the game has a positive expected value, your money steadily shrinks. After enough rounds, your $1 million becomes almost nothing. So what went wrong? If the expected value is positive, somebody must be winning. And that's exactly the point. The winners are the few extremely lucky participants. Imagine 100,000 people playing simultaneously. After many rounds, a small number of players will have extraordinary streaks of good fortune. Their wealth becomes enormous. So enormous, in fact, that it pulls the average upward for everyone. The population as a whole appears to be getting richer. But the typical individual is getting poorer. This is the distinction between two different kinds of averages. The first is the ensemble average. That's the average across many parallel outcomes. The second is the time average. That's what a single individual experiences moving through time. And in multiplicative systems, those two averages can be radically different. This is what economists and physicists mean by non-ergodicity. A system is ergodic when the average outcome across many participants matches the average outcome experienced by one participant over time. A system is non-ergodic when those two things diverge. Think about your daily commute. Sometimes traffic is terrible. Sometimes it's smooth. But if you drive long enough, your experience will roughly match everyone else's experience. The city's average commute time is meaningful for you. That's an ergodic system. Investing is different. The average wealth of humanity tells you almost nothing about your own future. You don't get to average your net worth with Elon Musk's. You only get your own timeline. That's non-ergodicity. This idea has existed in statistics for a long time, but its implications for economics remain underappreciated. Physicist Ole Peters famously argued that traditional economics often assumes, without justification, that economic systems are ergodic. As a result, people are encouraged to enter games with positive expected values without realizing that many individual participants are still destined to fail. Nassim Taleb has made a similar argument. The average outcome may look attractive from God's perspective, but what matters is the path experienced by mortals. Consider the stock market. Most retail investors fail to outperform broad market indexes. In fact, many professional fund managers struggle to beat the S&P 500 over long periods. Commentators often blame this on poor psychology, lack of discipline, or insufficient financial knowledge. Those factors matter. But there's also a deeper mathematical reason. An index fund benefits from the ensemble average. It owns hundreds of companies. It constantly removes weak businesses and adds stronger ones. A retail investor owns only a handful of stocks. The index enjoys the collective success of the entire system. The individual experiences only a single path through time. Again, ensemble average versus time average. So how do we deal with non-ergodic risks? There are 4 useful strategies. The first is surprisingly simple. Trade less. This is the accidental strategy of those legendary Bitcoin holders who forgot their passwords or lost access to their wallets. If you're confident in an investment, excessive trading often works against you. Researchers Brad Barber and Terence O'Dean studied tens of thousands of retail trading accounts and found a consistent pattern. The more frequently people traded, the worse their returns became. Part of this comes from emotional decision-making. Frequent traders are more likely to chase momentum and panic during declines. But there's also a mathematical explanation. Every trade is another coin flip. Every trade exposes you to another opportunity for bad luck. The more often you play, the more closely your outcome converges to your time average. And in many systems, that's not where you want to be. When your capital is limited, survival matters more than activity. Patience becomes a strategy for reducing volatility. This is one of the mathematical foundations of long-term investing. The second strategy is Taleb's famous barbell strategy. Put most of your assets in extremely safe places. Cash, government bonds, or other low-risk holdings. Then allocate a small portion to highly speculative opportunities. Ignore the middle. The goal is to maintain exposure to extraordinary upside while ensuring you never suffer catastrophic ruin. In spirit, this resembles the Kelly criterion. The flaw in our coin-flipping example wasn't that the game had a positive expected value. The flaw was betting everything every round. When you reduce position size, you dramatically reduce volatility. You don't need perfect optimization. You just need to avoid all-in bets. Investing a small, consistent portion of your income every month works for the same reason. The third strategy is to become the house. If most players lose to the market, why not own the market? Consider venture capital. A founder may spend years betting everything on a single company. Their reputation, savings, and career all depend on one outcome. That's highly non-ergodic. A venture capital firm operates differently. It invests in dozens or hundreds of startups. Most fail. Some succeed. One extraordinary winner can pay for all the losses and more. Venture capitalists aren't afraid of volatility. They actively seek it. They want founders to take risks. A mediocre company is often less interesting than a company with a small chance of massive success. Think of the difference between a parent and a football academy. A parent wants stability. They don't want their child injured. They don't need their child to become a superstar. But a football academy operates on portfolio logic. If 1 out of 100 players becomes world-class, the entire system succeeds. The player fears volatility. The house profits from volatility. That's the asymmetry. For ordinary investors, owning broad index funds is one way to stand on the same side as the house. The fourth strategy is risk pooling. If individuals suffer from non-ergodicity while institutions benefit from it, why not combine individuals into a larger collective? That's essentially what insurance does. For an insurance company, the average cost of house fires is lower than the premiums it collects. That's why insurance is profitable. So why buy insurance? Because a house fire is not an average event for you. It's a potentially life-changing event. Insurance converts a devastating individual risk into a manageable collective one. The same principle appears throughout society. Limited liability corporations work this way. Investors absorb part of the downside. Entrepreneurs can take risks without risking lifelong financial destruction. Families, communities, partnerships, and mutual aid networks all perform similar functions. They transform individual uncertainty into collective resilience. In a sense, they force the world to become more ergodic. So what's the big lesson? In multiplicative systems, volatility is not just uncomfortable. It can be fatal. Non-ergodicity means that positive expected value does not guarantee positive personal outcomes. For individuals, the priorities are clear. Protect your downside. Avoid ruin. Reduce unnecessary volatility. Think in terms of survival first and optimization second. Large institutions can embrace variance because they operate across many parallel bets. Individuals usually can't. That's why players fear volatility while casinos love it. And that's why, in the real world, wealth often flows toward those who can survive long enough to let probability work in their favor. Because in the end, success is not just about being right. It's about staying in the game long enough for being right to matter. That's it for today's content. Thank you for watching, and I'll see you in the next video.